Hey everybody, Jonathan Broadbent here, your host of UnWoke.Academy with another Wednesday live stream, noon Wednesdays. Mark your calendar. The plan is for us to have this conversation, to go live and talk about all things UnWoke and financial PMA every Wednesday at noon, with rare exceptions. So we are live right now on Rumble, X, YouTube, Facebook, and Substack. Substack, once again, is actually a separate camera and microphone. So on Substack, I was actually just saying before I launched this, if you're watching this on Substack, that's you, my Substack friends, there is a green screen behind me. And during the discussion today for all the other platforms, I am going to be referencing some of what's behind me on the green screen. You can't actually see it because, as far as I'm able to tell, in the current version of the streaming software in Substack, I cannot actually use a green screen. So at some point, I'm either going to figure out how to do that, or they'll change the software, or I will figure out a way to incorporate my Substack followers into the other camera and live stream. For now, this is what we've got. Feel free to join in the conversation. I can see on all of these platforms anything that you might be so inclined to type in. That includes questions, thoughts, comments, concerns. And as always, if you have or even can pull up on your device a statement from some sort of investment, that means 401k, IRA, etc., start feeding out some names of some of the investments that you're put into or have selected. And I will do my darndest, either in this episode or as follow-up, to provide some commentary. The whole how woke is my investment question. We've been asking that for a while now. I have spotlighted several different mutual funds and things like them. I call out the woke, and I want to spotlight and encourage people to invest in stuff That isn't woke. So, toward that end, just a couple of housekeeping notes. This is UnWoke.Academy. I refer to us as kind of where the freedom economy meets follow the money. I'm a follow the money guy. I made a career on and off Wall Street once I left Wall Street in tracking and managing an area of finance that today's objective, today's live stream is going to be to drill down into an area of expertise that I have. Stick with me. Parts of this involve math and numbers and some things that usually I know from experience. I've worked for decades in an area of finance that even I refer to as very sort of niche and often boring. But I think actually, candidly, it's kind of designed that way to intimidate people away. This is stuff that I think I can make bite-sized and help people to understand more about and empower you with great information to claim, I can't say claim some unclaimed funds, but to maybe advocate for yourself in a little different way that you might not know exists. So that niche has to do with the administration of workplace retirement plans. I know what you're thinking. It's if you studied any pre-law or law or work in accounting, that's ERISA. And even in finance, that's an area pretty much everybody's like, I don't want to touch it. I don't want anything to do with it. I actually found myself an expert in that and have studied it for decades. So this is me kind of serving up for you, a la carte, just dishing up and dishing on this whole marketplace. And I'm going to throw out some numbers that I think are going to shock you, that you may find surprising and hopefully extremely interesting. The first thing I will point out, and again, this is me, Substack, talking about the green screen that's behind me. And I always get reversed on the green screen. I have to check myself. I'm pointing at the wrong side. So there is actually a figure here of $14,410 difference. This is actually an example that was used in a post that I wrote up recently. And this begins to show the difference of even a small change to the fees that you're charged inside the plan. Yes, I know that can seem like that's somebody else's job and maybe human resources or the HR or benefits officer or CFO at your company. Most people, including most companies, feel, hey, somebody else has that. But today I want to talk about empowering you with some conversation that I encourage you to bring to those companies. If you are one of the estimated roughly 63% of the American workforce that has some kind of workplace retirement plan, tune in. You may want to make a few notes, and this is recorded. You can go back and rewatch and capture any parts of this that you want to kind of drill down on. But about 63% of America's workforce have access to a workplace retirement plan. And even if you don't, still tune in because you probably have some family members around you who do, and you may want to point them in the direction of this conversation. The first thing to know is that anytime you have a workplace retirement plan, it's 401k and lots of things like them, know that there's actually a lot that happens behind the scenes in order to deliver that to you. And there are a number of different people sort of with their hand in the cookie jar, if you will. Of course, if in a perfect world, they're all providing great service to the plan, doing their job well at a nominal and reasonable fee. However, a bad thing happens in the world of finance when there are fees that are hidden from you or are difficult to figure out. As soon as they become sort of vague and ambiguous, like a formula that you have to calculate, then a lot of people just sort of zone out and assume that people are doing the right things at the right reasonable fee. Well, let's put the US and then some averages into perspective. And I've got a bunch of notes here. Sorry to look away for a moment, but I'll check my notes to make sure that I'm referencing this properly. A quick trivia question about how much would you estimate exists in U.S. retirement savings? I don't have any of that Jeopardy music, and I don't have a singing voice. But the answer to the question is roughly $46 trillion. There are about $46 trillion in retirement savings accounts. Now, that's all combined, IRAs and 401ks and lots of things like them. Some public employees that are on things like public employee retirement systems, et cetera. But let's break that down a little bit further to kind of arguably the place where we, the people, you, can have the most impact, the easiest, I'll say. And that has to do with 401k. Drilling down of that 46 trillion, excuse me, there is roughly 13 trillion in 401k plans. And for the purposes of today's conversation, instead of saying 401k plans and things like them over and over again, just take the use of that term as kind of a blanket term. When I say 401k, there are other similar types of plans that work in much the same way. And I'm just going to refer to them all as 401k. Makes our conversation easier. If there are $13 trillion saved up, and that means your employer, or remember the employer where you left and you left your money there, that's A-okay, probably. But keep in mind that that's part of this conversation, and that's part of that $13 trillion. Now, where we get into where you can have some impact, and you can have some impact fairly quickly if you do the right things and follow my suggestions that I'm about to lay out for you. Let's assume that there is some sort of plan advisor, a broker, somebody, some sort of financial person, a bank rep, or an insurance agent who is representing that plan. They've sort of sold that plan to your employer. Let's attach a fee for them of 0.75%. I've done extensive research, and I consider that to probably be a pretty good average fee for advisors, or plan advisors in particular. So if your company retirement plan has whatever it has in it, X million dollars that's saved up between you and all your colleagues at work, and you're paying an annual fee of 0.75%. Every year, you are subtracting money from your accounts to pay that individual. That's all well and good, and there's nothing wrong with that, but there is an alternative that not many people know about, including a lot of people who are what are referred to as CEBs, or Certified Employee Benefit Specialists, and human resource officers, a lot of CFOs, etc. The first thing everyone should know is that the fees that are going to pay different service providers for your 401k plan, there's no requirement that all the employees have to pay the fee, that the employees be saddled with paying that fee. I'm going to pause to say that 401k plans are actually a very good way of saving. They're a tax-deferred savings vehicle, and fought for well and advocated for, they can be in a highly efficient way, pardon me, of amassing money and building wealth for your future retirement. But there is an alternative to paying that 75 basis point. Again, this doesn't apply to your plan. This is a general ballpark figure. Your plan, if it has a plan advisor, may pay more, it may pay less. But we're using that 75 basis points, or 0.75%. Those are the same. They're just a little different terminology. 0.75% is the same thing as 75 basis points. That's just my world. That's how we tend to calculate and use those terms. This behind me represents a small investment. This is actually $10,000 over 30 years, expressed in the difference between paying 75 basis points, again, 0.75%, versus not paying 0.75%. The ultimate difference to you as a saver is $14,410. That's not even actually compounded. There's a compounded example I've done that is a different slide. I'll get to that in a moment. It takes me a few mouse clicks to change the background screen. But that actually totaled up in, again, just using some ballpark figures, to about a $220,000 difference. In a recent web search, I used Brave. I actually prefer Brave to things like Google. I did a Brave search, and you can do the same thing, looking at average plan advisor fees and the difference. And it came up, Brave search came up with, I think it was about $563,000 difference if you can eliminate that fee. And that's what I'm here to tell you today. In today's conversation, I want to let you know that there is no requirement that that fee be paid out of your accounts. If, and this is certainly an if, this isn't for all companies, but if you can convince your company to pay the plan advisor directly, the first thing to know is that they'll probably grouse and grumble, because a lot of people in finance have become very accustomed to the idea that their fee just gets sort of subtracted out, and it's not very clear and apparent. As soon as you put daylight on it and make that fee obvious, then all of a sudden people feel like they're on the hook. Well, there's a little bit of detail to navigate on this, and bear with me, but I want to put it in proper perspective for those companies that have made that choice, that have actually, pardon me, let me take a sip of tea. Hot tea with honey and lemon, that always helps. So I have to keep my voice going. I've ended up in a line of work where I do a lot of talking. I have to keep hot tea with honey and lemon. I recommend it highly. So in the typical setting, and this is very common, most 401k plans have a plan advisor, and most all of them, a vast majority, the advisor gets paid out of the plan assets, which means consistently and an ongoing basis subtracting out of or siphoning off of your retirement savings. So if you're one of those people that either likes to manage and track the fees and expenses, and I know lots of people, I'm one of them. You're looking at the streaming services you pay, or what sort of, what's on your mobile phone bill or whatever. If you're that type of personality, apply that to your 401k plan. And absolutely, that's the whole reason that you get that fee disclosure document. You probably receive one in the mail on an annual basis from your 401k that outlines the fees that you pay. From that, you can start to extrapolate how much you're losing Okay. So, Substack fans, if we're going to be turning to you for audio, because I have discovered that that when the audio glitched, it did actually glitch across all four platforms. So, Facebook, YouTube, X, and Rumble followers. I apologize for the confusion there. Something happened with the software that I use that allows me to stream, and the audio glitched. Hopefully, you should be able to hear me now. I have no idea what caused that. I'll research this after this episode. But what we're talking about now, just to quickly bring you back up to speed, and do find this on Substack, because you're going to find all of the audio and you'll be able to actually hear the things that I was just talking about. And thankfully, that's actually an upside. I've run into this before. I will pull the audio and add it back to the video stream later. But where we are in our discussion now that there is audio back again on those platforms is the difference between employees who have access to something like a 401k plan paying fees to have a plan advisor versus the company itself paying those fees. There's a world of difference, and you start to see it represented here behind me in this illustration. And this is actually a very small one. This is a tiny example using $10,000. And over a 30-year span, this actually compares a 0.75% drop in fees. So all things being equal, as I said earlier, if you're the type of person who looks at the fees that you pay for things like your mobile phone and streaming services, etc., apply that same sort of critical lens to the fees that are paid inside your 401k plan. Also, if you're the type of person who enjoys opening up your statement and looking at the growth and performance of your investments, know this. The only thing you can certainly affect is fees. Lots of people try to speculate and time the market and feel that maybe this mutual fund or that other investment will do well. And I certainly hope that you do well. I hope that your investments perform splendidly. And I'm going to get into that in a moment as well. And that gets into, stay tuned. We're going to get into sort of the current norm for investing versus America First. And there's a world of difference there. But let's just compare apples to apples. Whatever your funds are now, whatever you're invested in, no ifs, no change needed. Whatever your current investments, if you subtract out and eliminate fees, your investments will do better. That's just basic math. It's like, think of this like, think of it like running your air conditioner or your furnace with a window cracked open. Or in the case of those plans that I highlighted that might be north of 1% in fees, this is just 0.75% illustrated behind me, and it's a small number. But imagine if you have a 401k plan that's got fees of 1 or 1.5% to go and pay a plan advisor. The thing that not everybody knows, and I've been pushing on this for years, and sorry, Substack, I'm kind of repeating myself, but the audio glitched. Going back over the thing that is not well known is that there is no requirement that the employees of a company pay the servicing fees for the 401k plan. Now, it certainly is at the discretion of the company. The company can decide, and it's perfectly legitimate and reasonable and legal for them to attach the fees to your plan, which means that you and all your coworkers pay a little bit out of each cycle. It depends on how frequently they take the fees out, typically monthly or quarterly. But If you can convince your employer that there's a better option, then you're to the good. And again, recapping where this comes from and maybe giving a few breadcrumbs to encourage you to learn a little bit more about this. I actually started in 2009 as fee-based401k.com. That's still one of my domains, and it just simply redirects to my current company. I later launched fee-based403b.com. 403b is similar. It's a kind of a cousin to 401k plans. And the conversation, the mission for me, at least 16 years, and actually going back, I started doing things that were similar in 2002. I advocate for, and I have some huge wins in encouraging companies to switch and pay a service fee directly to one or more of the companies that provide service to the 401k plan. Now, there are several, typically. If your 401k plan has an advisor attached to it, it's super easy to look at and understand. And once you get the premise of it, I suggest that the next time you get one of those fee disclosure documents in the mail, you're going to be armed with a lot more to be able to put that in perspective. So when you get that document, and it's thank you for reposting and restreaming. I appreciate that. And by the way, that's a hint to everybody else. I do see the comments that you make. Feel free to post comments and questions. If you have some mutual funds, for instance, that are in your plan and you want to know whether or not they're woke, send them to me. We'll dig in, we'll drill down, I'll get you info. But back to the matter at hand, and that is trying to get you in a better place in your saving for retirement. So I do feel like I'm sort of I'm retracing some steps here that, again, I apologize for the audio glitch that happened on the streaming service. So far, I actually switched because of Ken Walls from Breakthrough Walls to this software that I use, and I love it. I use EV Mux, and I have very, very few problems with it, but today it glitched. So retracing steps here, according to my research, there's an estimated $46 trillion in retirement savings in the US. Of that, about $13 trillion are in 401k plans or things like them. And for ease of conversation, I'm going to refer to all of them as 401k plans. There's some similar types, but they factor in, and rather than say 401k and similar over and over again, just going to call them, use the blanket term 401k. In 401k plans, if the figure that I've used right here of 75 basis points, in this example behind me, if I'm right, and 75 basis points is an average plan advisor fee, that means that the 401k marketplace alone for plan advisors is a $97.5 billion profit-making machine. And again, putting that in perspective, let's compare that to the pharmaceutical company Pfizer. Their profits as a company, the largest pharmaceutical profit-making, the highest profit margin of any pharmaceutical company, their most recent revenue profits, their most recent reported revenue is $13.72 billion. So normally, those of us who follow these kinds of things are like, wow, that is tremendous profit. By the way, I'm not recommending investing in Pfizer. In fact, quite the opposite. And you can go back and watch some of the episodes where I talk about the headwinds that pharmaceuticals face because of things like COVID and all kinds of stuff. I won't get into detail on that. But I'm just using that as perspective because, wow, $13.72 billion is huge profit. But compared to the profit from plan advisors working on things like 401k plans, that's chump change. $97.5 billion, in other words, gets subtracted out of workplace retirement plans to go and pay plan advisors. I'm not saying that, first of all, 401k plans are helpful and beneficial. It is a great way to save for retirement, but it doesn't mean that you should take your eye off the ball and not be in a position as often as possible to know the details and advocate for yourself. Push. Constantly be pushing for the best you can possibly get. Because while it is a great vehicle, it's spectacular overall. For tax-deferred savings for retirement, it has all kinds of great protections for you, etc. They're wonderful. But it doesn't mean that somebody couldn't come along and attach a fee to it that is unreasonable, or that you might be able to strip out and get rid of. This, of course, is not a specific an indictment of any company or your 401k. It's to arm you with information in general about how this marketplace works. So if I'm right, and 75 basis points is an average fee for plan advisors, and we have a $97.5 billion marketplace for plan advisors, then let's extrapolate that and expand it to the full, broader retirement plan world of $46 trillion. Applied to $46 trillion, we're much more like $440 billion. There's a range of estimates, and you can see in some of my prior posts where I talk about using a figure of 220 billion versus 440, whatever it is. Let's use the low figure of $220 billion. If there were a magic wand, and if I could advocate for companies out there to switch, if possible, and not saddle the employees' savings accounts with the fee, it's the whole concept of what happens to U.S. retirement savings if $220 billion stays with the employee. What happens if that money gets left alone and stays in their accounts to compound and grow over time? What you see behind me is not even actually compounded. I do have another slide. I will, in a moment, I'll see if I can find it and bring it up behind me, that does compounded, and it compounds over 30 years at 7%. And I actually, for that one, I used a 1% fee. 1% fee versus no plan advisor fee. And on that one, we started with $100,000. So hoorah, you've done a great job for my illustration, and you've saved up $100,000. And over the next 30 years and that's a flat fee. It doesn't even consider your paychecks and doing additional contributions. That's just to simplify the math and make it easily understood in a visual format. It amounted to an over $220,000 difference. So, would you want that difference? The answer, I'm certain, is yes. And all things being equal, if you are going to go into your human resources office and advocate, arm yourself with information. When you get that fee disclosure document, make sure that you understand the fees that are being assessed and put that into context. What you're probably going to find is that the HR and benefits director will be intrigued, I hope, because they probably have money tied up in the account as well. And if you can convince them, hey, let's get on the same side here, and let's put together a proposal to go to the employer, the owner group, whoever it is, and suggest that they pay this fee directly. Now, if they do, and the company says, oh, yeah, that makes a lot of sense, it's moderately common if we can get to that stage in the conversation for them to agree. Then that fee that you pay as an employee that gets typically siphoned out of your account in small increments over time through the course of your investing life disappears. It goes to zero. All else being equal, you end up with more money, maybe retire sooner, probably retire happier, and would retire with more money. Again, all else being equal. One of the things that I've done connected with feebased401k.com and now this company that I have run since 2012, Plan Partners, is advocate for a few more things. Because why do I do that? My reasoning it should seem pretty clear to you. There's something that is a major issue that I've been aware of for a lot of years in the United States called unfunded liability. Put simply, unfunded liability is the difference between what's been promised to future retirees and the money that's available. The fee structure that's low-hanging fruit. If we can subtract, if we can compress the amount of fees that disappear out of the accounts, all else being equal, we have an American workforce, our great American workers, in a better position to retire sooner. And we don't face the unfunded liability issue, at least not as bad as it currently is. Now, there are all kinds of different directions we could go with this. I've had a lot of exposure to public employee retirement systems and union plans and all those sorts of things. And if you're anywhere in proximity to those, yes, it is true that there are some problems with those. And I've been parts of various different teams. I've worked on states. I've worked on energy companies, public utilities. I've worked on a lot of that. That is a sticky ball of wax. And I will continue to battle and advocate for those to the best of my ability. But for today's conversation, let's talk about the average rank and file for-profit employee of a company that is that's for-profit and preferably private, because it's a lot easier to do for private companies. If you can bring this conversation to your employer, and if your employer likes it, remember, again, to bring that piece of the conversation that highlights the impact to them, because it's common to find, especially in small employer plans, with a small group of employees. Let's say that you got an owner, maybe controller and CFO and benefits director and sales manager, et cetera. Often they actually hold the lion's share. They might own 50% of the 401k plan. And if you're telling them, and they can do the math, they can watch this video and the ones that I've done like it, the posts that I've done like it, and all the slides that I've done that are similar to the one that's behind me. And they can do the calculation. If they figure out that each of them would realistically end up with however many tens or hundreds of thousands of dollars more money, and all they have to do is move the plan advisor fee to a different balance sheet and pay it directly, it's an aha moment. Everybody ends up happier, except for the insurance company, bank, Wall Street firm, whatever, the plan advisor, who maybe have been collecting fees for however many years, and who knows what they've done in exchange for that. But there are a few things to know. The first is, if the employer does that, if your company does that, there should be, most likely will be, a tax write-off, because that's a professional service fee. They can talk to their accountant about it and see what sort of tax write-off it is. But assume for now that the numbers we've been using so far are correct. I would ballpark an average plan advisor fee per plan at around $70,000. So in my world, as what's referred to as an ERISA specialist, I support lots of different types of bank reps, insurance agents, salespeople, Wall Street, law firms, financial and accounting firms, you name it, who have questions about the ongoing administration of a workplace retirement plan. Based on that lens, I ballpark the fee, average fee, at around $70,000. If you take the $70,000 and simply leave it with the employees, give them that $70,000 additional per year, they end up better off, all things being equal. That's really the gist of today's conversation. However, here's an interesting thing. I took the estimated $97.5 billion profit nationally, I'm getting ahead of myself. I took the estimated $97.5 billion marketplace of 401k plans, and I actually divided that by a research into the current number of active plans in the US. According to those figures, that's 718,736 plans in the US. That means 401k plans for the most part. Based on those numbers, the average plan fee for plan advisor is $135,658.54. So we've got a huge span there using that low number of $70,000. And again, working with your CFO or your benefits director, you can pretty easily figure out what a plan advisor is getting paid out of your plan and the potential benefit of moving it to a fee-only type of structure. But let's use the $70,000 and, as a back-of-the-napkin rough sketch, anticipate the eventual added value to all of those employees. Would you like to retire sooner with more money? All else being equal, that's a given. That's the thing that you do have control over in your 401k plan, you collectively. So go in and advocate in your human resources and benefits office. This actually gets a little bit more into the weeds. I know this has been a sort of a dense subject. And then we had that weird audio glitch. So sorry if parts of it kind of repeated once I sorted that out. But let's assume that you've taken this step and you went to your employer and they're like, oh, wait, I like it. The light bulb goes on and they realize that they can save some money and build more wealth and have happier employees. Well, as soon as, how do I want to put this? Let's assume that your current advisor gets a fee that's subtracted out of your account. And your current advisor is not the only one that gets a fee that's subtracted out. You might have a custodian, a plan provider, legal, tax, all kinds of different fees might come out. By the way, that's a hint. When you get that fee disclosure document, read the thing. It's there for your information. If that's the case, then it's inherently problematic for that plan advisor to aggressively disclose and advocate for low fees, because they are inherently drawing light to the very thing that pays them. So I'm advocating not just for employees of companies and human resource and benefits directors, but also other financial professionals. You know the lens, the scrutiny with which those fee disclosure documents are reviewed. Why risk it? And by the way, if you don't want it, call me. I'll work with you. I'll get things cleaned up and squared away in a comfortable way that makes everybody happy. If you can, duplicate everything I'm describing here. Apply it to your financial services firm. I talk to advisors all the time. I coach them through it. I coach them through doing exactly what I'm describing here. More should do it. So when you get there and you've got a company that has made that shift and they're paying the fee directly and hopefully getting tax deduction, remember there are a few more pieces to it. One is if it's a small company that is starting a 401k plan, there is actually a 3-year tax incentive for companies, small businesses, to start 401k plans, and that's $5,000. That $5,000 is a dollar for dollar top line deduction from corporate taxes that's available to small businesses. So whatever you negotiate with a plan advisor, 5,000 of it is really just free, effectively. So that really should have an impact on small businesses that might consider this. So for the first 3 years, you get that tax credit. There are a few other things that are to the good and benefit for getting an advisor to work directly on a fee-only basis. If you have an advisor on fee-only basis, that means that all the scrutiny of the things that happen inside the plan. And I've made myself some notes here. There are 3 general categories to consider for activities inside the plan. You've got legal and management, the investment oversight, and administrative. There are all sorts of avenues for that plan broker or advisor, the plan advisor, whatever you call them, to make ancillary additional extra money. And the moment those exist, you have conflict of interest issues. And the moment those exist in an environment where you're not sure or it's unclear exactly what their compensation is and how much they're making, it makes it difficult to impossible for you or anybody else to effectively advocate on behalf of your company and that 401k plan. Moving it to a flat fee just makes all the sense in the world, because suddenly you have somebody who is clearly and with no conflict able to advocate better for your plan. That's the argument that I've been making since 2009. Yes, I understand that there are a fair amount of details, and a lot of this is new to people. It's a new sort of area to grasp, and it is true that for most people, and I've had thousands of conversations, as I said, all across the country, north to south, coast to coast, and for the most part, most people feel that somebody else is managing it. But at a certain point, there has to be a buck stops here mentality with somebody with the wherewithal to step in and advocate firmly and solidly on behalf of the plan and its beneficiaries. That means you. There are some great human resources offices out there. I think I'll give 2 relevant examples of success stories when companies have gone to that type of fee structure. In one, I personally was invited into an energy company, and I was asked to do an examination. In the energy company, we fairly quickly figured out that among all the different service providers and fees that were assessed, the platform, that's, I think, where you log in. You log into the platform, and that's where you get to view your account. That platform was charging 11 basis points. That's a little bit more than 0.1%. That's a pretty good figure. It's fairly low. 0.1%, all things being considered, is pretty low. However, we fairly quickly figured out on my team that company, the provider, that platform, that wasn't the only way that they were making money. And that, in fact, it was the smallest way that they were making money. They were making a lot of money through other things. Well, very quickly after we arrived on the scene, that 11 basis points was dropped to 0. So we have, in that case, a plan advisor fee that dropped to 0 and a platform fee that went from 11 basis points to 0. Those are the kinds of things that become more common and much more possible when somebody steps in with the wherewithal who is not conflicted and is not themselves deriving revenue, deriving income from, is hidden too harsh a term, from obscure means. Then from there are all sorts of things that those people can do in a better way. I'm going to give one more example, and then I need to sign off. I'm going to go and heat up my hot tea with honey and lemon and nurse my voice a little bit. But in another example, I actually ended up in a very, very large national law firm. It's one of the largest of its type in the country. And that law firm actually done a very, very good job of negotiating their fees. And so here I am invited in, and I sat around the boardroom table with the managing partners of the law firm. These are some pretty bright people. They had been, each of them, very successful in their legal careers, and they're fighters. And they're used to being fighters. They pride themselves on advocating and fighting. So they told us, I brought in a team, and the first thing they said was, we're very confident that we have done all that's possible to compress fees and get them as low as possible and get the best possible service in exchange. Because remember, that's a key component. And actually interjecting, that's a critically missed component of advisors who get paid a fee out of the plan. They're generally speaking not in a very good position to advocate for better service from this provider because they and the provider are also collecting fees. It's hard for that person in that position, that plan advisor, to go to the plan's providers and say, yeah, I know I'm kind of collecting this big fee, but could you reduce yours? Or could you ramp up the services that you're providing? Make it easier on their human resources office and their benefits director. That conversation is not only difficult, it's kind of doesn't happen. But for somebody outside the plan who is not collecting those fees and has no connection, they're not receiving any sort of value from that plan provider. They're not collecting those fees. That becomes more, it's easier for them to go and hold the thumb screws, lowest fees with the highest possible services. But anyway, back to my example. Here I am at the boardroom table with this law firm and sitting around with these lawyers, and they're very confident in what they had accomplished in getting low fees with good service. Well, it took us a few months of examination, but we fairly quickly uncovered an array of fees that they weren't aware existed. They were disclosed, but the formulas that were used to disclose the fee structures and the if this, then that, then this fee, and then that would lead to this other type of fee. It was, even the lawyers were like, their heads are spinning. So we uncovered that and brought it to the attention of this board at the law firm, and they were dumbfounded. They were amazed that we found profit that these providers were deriving off of their hard-earned savings and their 401k plan that they hadn't figured out. It's my understanding that not long after, they actually switched to a new provider, and then they actually went back and sued the previous provider. I don't know if they won that lawsuit because I have a feeling it was thoroughly disclosed to them, but it was disclosed in such a horrible way that it made it virtually impossible to uncover. That's the world that I work in. That's what ERISA specialty means. I'm not the only one. I would say among those, there are several hundred in the country, and I would say about 30 of us we operate completely autonomously and independent from anything and anyone. When needed, we're highly valued, and we provide services to all kinds of different companies. As I said, banks, insurance companies, law firms, accounting firms, the benefits, some of those mergers and acquisitions and conglomerates. But the more of this world that you know, the better you can become at advocating for yourself. So hopefully this makes sense to you. I've actually done a series on this that you can find. I would start actually with the 3-part series that I did, Behind the Veil, on 401k plans. And recently I've been talking a lot about that flat fee arrangement. So everything that I've discussed is universal. It can be applied by anybody, anywhere. And the last 2 pieces of this, if you are following UnWoke.Academy and the research that we're doing into finding not woke investments, and that means uncovering the woke stuff that is surreptitiously hiding within the 401k plan offering, very typically, and are interested in doing better for yourself and the country and investing in things that are actually free market economy and might very well be the next new thing and drive America First conversation, know that you should also be talking to your plan, to your employer, about adding self-directed brokerage account. That's another piece. I've talked about that in length in prior episodes. SDBA, or self-directed brokerage accounts, are a terrific way of eliminating yet another fee. That's that investment management fee, that carried cost of investing in things like mutual funds. Mutual funds have an annual expense to them. You can eliminate that. Know that there will be a trade-off. You're going to get some sort of trading costs. I get into that in prior episodes as well, but all things being well, I'm using the wrong term there. Not all things being equal. According to all of the math that I've done, for everyone I've addressed this conversation with, it is a monumental savings to them to get out of managed, get away from the woke, far left managers, take matters into your own hands and build a portfolio with legs. That means investing in things that you can see, understand, and know, and you can track, that meet your value system. You can do that inside of your 401k plan. It just takes a little bit of knowledge and some understanding and getting access to better investment alternatives. So everything I've discussed here so far in today's live stream is universal and can be applied anywhere by anyone. If you are hearing this message and you're interested in what I personally have to offer, I'd love a phone call. I would personally love the opportunity to be involved in the conversation if and when your company goes out there and does an evaluation. Again, there's no obligation to that, and you might have a great plan advisor, and maybe you can convince them to switch to flat fee. Great, that's a big win for you. But consider me as an alternative. A big part of the reason for that is I want to drive a lot more conversation in large pools of money, like 401k plans, about defunding the woke. Let's get our money out of the hands of the woke left and talk a lot more about funding America First, MAGA, and a better, brighter future for the United States and for the West. Because that is the future that our next generation will inherit. That said, I'm going to wrap things up here. Hopefully this made sense to you. If there are any questions and or you want any feedback is welcome, Feel free to reach me directly via email at info@unwokeinvesting.com, or if you want it publicly known, feel free to post comments underneath this live stream on whatever platform you're viewing on. Until next week, I'm Jonathan Broadbent with UnWoke.Academy. Thanks for tuning in.